Hi, in this video, I'm going to give you some helpful hints on how to get started with the portfolio analysis case. So let me just move this up a bit so you can see the worksheets down here. Let me make the instructions a little bit bigger so everyone can see easily. So the first thing here is to combine the information from the fund database to the worksheets for the mutual funds. They want to bring this information over. Okay. So Fund 1, I'm going to put some colors on the tabs just so it's easier for me to know what tab I'm on. It makes the file look a little bit better too. So the first thing I'm going to do is I'm going to use a VLOOKUP. And I need to bring this fund database. This is the information I'm going to bring over. So let me just go ahead, the mutual fund 1, pop that over here. And let me I'm just going to shrink these columns so we can see the ones we're working with. Okay. So company name. Of course, what we would do here is insert a VLOOKUP, and I'd use the symbol, and then I'd go to the fund database, select these 5 columns. Oops. Let me start over here. Back here. All right, we want to start with this column. Table array is from the fund database. Column index, first 2, and then false because we want an exact match. Okay, done. So what we got returned to us was a 0. So there's something not matching. So there's a note here. Okay, so saying that the fund database isn't exact. This has more entries in it than the other, but I'm going to look at symbol here. So this is a general, and this is general. Okay. Oh, I see there's a space here. So you could use a trim function. What I'm going to do is I'm going to do find space and replace with blank. Okay, so 560 replacements. So let's see. It still hasn't, I don't think this formula is right here. So I'm going to do a VLOOKUP again. Okay, so that worked. And I got the company name here. And so I pull this down to get the company name. And now what I could do is I'm going to pull this over like this. And I get this NA here. Because you can see here, when I pull it over, it starts switching the columns. So as you know, I would have to make absolutes here. So the A column, I'm going to put some absolutes. Let's see, $sign. Oh, stop that. $sign. $sign. So we don't want these to drift. Put these absolutes in. Let's see if that works if I drag it across. It does, except now it's bringing in the name in all four. So each of these would have to go in and modify them for this. This is the column index. Okay, so let's review and see. So 585, 176, 597. So let's find TX. Okay, so when I zip, it matches. And what I should do on this page, of course, is freeze the top row, because I hate it when I'm going down and I can't find the see what column I'm in and what the title is. So let's freeze. Let's go ahead and just do that. While I'm here, I'll do that on all the pages. Just because it'll be easier to travel around. Okay, so now I'll just flash fill these. Okay. Step 1 done. Step 2, calculate this year's return by each stock and total fund. All right. So first thing we're gonna do here is let me resize all the columns. And then let's just go back and see here. So what they want me to use here is January 1st price and December 31st price. So we started the year on January 1st, we ended in December 31st, and there's a nice example of here of how to calculate the return, which is new minus old divided by old is how I look at it. So let's go over here and let's make a new column, and we have these prices here. So I'll make a new column, January 1st. So let's open this up, and we'll call it what they're calling it, this year's return. Now, one thing to do if I don't want to make my columns bigger, so what I'm going to do is, of course, I'm going to wrap the text. So this way this doesn't have to be. And if after I wrap the text, let me resize the cells, and then, okay, so now I can make the more stuff viewable on the screen. And of course, I always like to put these borders and then have a thick border around it. And I like to center and center. And see, it'll look nice and it'll look a lot better. And you can also, if you want to, you don't have to, you can put a light color. I'm going to put a color kind of matching the color on the tab. So that way it looks a little bit more organized, looks a little neater. Now, return. Okay. Plus. Parentheses. New minus old. Actually, that's the opposite. This is the newer price minus the old price divided by the old price. Okay. So, and this should be expressed as a percentage. So that does look like a 500. That's a great return. So let's copy this down. So we have all our returns. And do they look right? So you always check. So 16 to 32 is definitely 100% return. So we're looking good here. So let's go back to the memo. B. Calculate next year's return. So December 31st and next December's estimated price. Okay, so we're going to copy. So let's go back. So here is next December's. So let's insert a column here. And we'll say, let's copy this over. Next year's return. So again, the new price will be next December minus the old price, which is last year's December, divided by the old price, which is last year's December. Okay, so let's put a percent. So that's next year's estimated return. Flash fill that. Back to the memo. And then give an example here. C, calculate next year's return by stock and total fund. So, okay, so this is using, so here we calculated next year's return by using the estimated price. But now we want to calculate next year's return by using the December 31st price and this forward PE estimate. So we're going to create a new column for the result of forward PE times. So calculate next year's return and total fund using this information. Okay, so let's forward PE year one times earnings per share. So let's go back to the mutual fund. Where is forward PE? Here it is. Forward PE, and then we have earnings per share here. So let's see here. Earnings per share. Okay, so we have our two columns that we need. Now, so since we have our return columns here, I'm going to create a new column here. And let's insert a new column. And we'll keep this the new column. All right, so we're going to call this, let's call this the forward P/E value. Okay, so what we're doing here is we're taking the forward PE, which means the estimate of what they think next year's PE is going to be, multiplied by the earnings per share. So we don't want a percent. What we should do here, these are dollar amounts, so let's make them currency. And then we'll copy the formatting here. We have currency, 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 currency. Okay, so we'll just keep that. A little cleanup on the formatting. Okay, so let's take that off. So this would be, so what does this mean? Basically what this means is, this is the estimate, next year's estimated price. That's one estimation model. This is a valuation model. So, so I could actually say forward PE. So this is an estimate of what they think the price to earnings will be next year. If we multiply it by the earnings per share, we can get a different estimated price. So now we have to calculate I'm going to copy this title here, put this here, and I'm going to say return. So we're going to calculate a return using this. So this becomes our new minus old, I think this is the old, divided by old. But I have to put in the parentheses here. Okay, and make this a return percentage. Now let's check to see if I had the right columns. So here it's saying December 31st and forward PE. So here's the example. And okay, so that's right. So I did it right because I used, there's a button here that will show formulas. I forget where this button is because it's on my other computer. I have it, and it will show Let me pause this. I found it. So I'm going to click on this cell. Let's make this a little wider. And the button's on formulas and it's called show formulas. So here it'll show everything in formulas. So that way we could see I'm taking H minus D, which is December 31st divided by D. Okay, so let's turn that show formulas off. So that's a good way if you want to see your formulas in the whole worksheet. Okay, so let's just make that smaller. Okay, so we can see here for this second item, the forward PE is actually lower than the December 31st estimate. So this is just using two different valuation models. So let's go back to the memo. So in the memo it says here, calculate the mean, standard deviation, and coefficient of variation. And I think I would like to have this in caps like the other words because it's no less important. Per fund for the results of A, B, and C. Okay, so let's go here. And I'm going to let me insert two new rows. I'm going to do it like this. Let's say mean. Standard dev and coefficient of variation. All right. All right, so we have those three. So we need it we did calculations. We have a calculation here. So let me set that in and we did our calculations. This is A, B, and C. Let's actually put these in. So let's give it a little special formatting here. All right, so how do you calculate the mean? Well, you could just use the average function. So I'll just use the average function, and we want to start here, all the way to the bottom. So this is the average return. Standard deviation. Let's use the standard deviation model. So actually, let me shrink this here, and I'll just search for it. Standard dev. We just want the standard dev. So number range 1. We just need this number range that we're going to do. Let's hit OK. Okay, so this is the standard deviation, and let's format that number. Okay, coefficient of variation is going to be simply we take the standard deviation and divide by the mean. So let's take the standard deviation and divide by the mean. And this is the coefficient of variation. Okay. So this by itself, this doesn't mean anything. However, if we put it over here like this, we see that the year one returns have the highest average. Next year return on this estimated using this first estimation as a valuation model is we're seeing a 4% return next year with a much lower volatility. So, but if we compare that to, but standard deviation can't be compared by these three because they have different means. So the coefficient of variation is what we could use to measure the three. And we see that we have a coefficient of variation that's higher in G than E, so it means that there's actually more volatility in this model. In the forward PE model, we see actually a negative return and a negative coefficient of variation. So it's sort of moving in a negative correlation. It's just some statistical work here, nothing big, but oftentimes with portfolio management, you will use statistical models to help analyze your findings, your different returns. All right, so let's go back to the memo 3. Create averages and totals for each column. Let's move this, let's close this box here. All right. Create averages and totals for each column. Which of the 3 funds have the highest return? Return on equity, return on assets, operation margin, short ratio, book value, return. Make a chart to display this information. Okay. So we have to decide on each column. Let's go back here. So let's create another row. And this will be, we'll just call this our, we don't know what to call it just yet. So shares owned, that does seem like that should be something that we can add up. So we can get the total shares owned. There's anything that's like an individual price. Adding these together won't do anything. So this would be more of an average. So let's use the average function. And then we can select this whole column. And you see I use my quick keys to get around very fast. So we can put, this would be an average. This would be, which is a mean. We'll just get an average for this, average volume, average earnings per share, average PE, average short ratio, average PEG ratio, average forward PE, average book value. So these are all the averages. Okay. So that would not, this doesn't add up there. But we could do averages here as well. These make sense to make these averages. So, okay. So let's take the change. This is not a dollar symbol here. This is a number. It's just average volume. All right. And these are not dollar amounts. So let's make these just number. And the same thing with these are actually averages. So we're going to make these number. Okay. Now this won't work here because we have this, this is B and M. So these are billions and millions. So in order to get the average market cap, we're going to have to figure out a way to change this information here. So I'll leave you to figuring out how to fix that. And you could do, there are certain, in cleaning up your data video, there are certain ways that you can fix this so it's the actual number, not the abbreviation in billions or millions. So I'm not going to do that for you. I think it's easy enough for you to do. So moving back here, I'm just going to, so we actually have shares owned. So we could actually calculate, you know, the total value of the mutual fund on January 1st and December 31st. So we could, and that'd probably be a good thing to do. So let me just, I'm gonna put insert here, and insert here. And this would basically be back arrow key plus a shares owned multiplied by price. Same thing here, shares owned, multiplied by price. Okay. And we can copy this down. And then we could use a total here. And we'd have to make a column here. So in this column here, what we're going to say is, let's call it dollar value, January 1st, and this would be the dollar value, December 31st. Okay. So we can see that the mutual fund, it's important to have the full dollar value because we can see the mutual fund move from 198 to 400, which is about 100% increase. So that's the actual weighted average increase, which is important. So we can just leave that there. So let's go back to the memo. Create totals, averages. Okay, make a chart to display this information. So that would be maybe what we could do is, instead of chart, let's say make a table. Because to display the information. So that you should know how to do. And I'm talking about just the information that we just calculated here. So one way to do this is I could just take this information here, copy it, move over to a blank area, and then I could paste special, and I can transition or transpose. So I could get it sort of like this. I don't need these three columns. Delete that. So I could make a table here, but you see how the formula, I should paste special. Values only, because when you copy the formulas over, it's not going to work. So again, here, paste special. And when I get my box, I'm just going to say transpose, but I'm also going to say values in number formats. So that way, I'm going to get my, delete these three columns. Relabel that so that we have so here we'll have a table. So to make a table, made a table. And I guess what we could do is we could put this table and we could mutual fund 1, 2, and 3 and make it more comparable later on. All right. Okay, create a pie chart. Create a pie chart by breaking stocks into the following: PEG ratio 1 to 2, PEG ratio. Okay, so what you'd have to do here, of course, is each fund has the PEG ratio and they're varying. So you want to have what percentage is 0 to 1, in a pie chart. So what percentage is zero? Maybe it's 25%, 0 to 1, 50%, 1 to 2, and 25%, 2 to 100. So how do you do that? Well, you're going to have to go in here and maybe make another table and do a count if, and you count how many stocks have a range of 0 to 1, 1 to 2, 2 to 3, and then you can make a little table using a count if, so that way you can easily get the numbers to make the pie chart. And you can do the same thing with the market cap, but you'd have to convert the market cap into full numbers to make the pie chart for that. For each fund, find the number of stocks that have a 50-day moving average, a higher 50-day moving average than a 200-day moving average. So you could use an if statement here or count ifs to figure out the number of stocks that have higher 50-day over a 200-day moving average, and then create a detailed compare and contrast each fund in the develop an analysis recommendation for an executive summary. Okay. So that should all be doable. So I think I walked you through, in half an hour, I walked you through some of the more complicated directions here, and some of the stuff I left you to figure out, and you could even, when this 50-day to 200-day moving average, for each fund, find a number of stocks. So you could also do something like, here's the moving averages. So you can insert a column, and you could say, you can put a little if statement in here. Let's put if. So as writing the if statement, the logical test would be if the 50-day is greater than 200-day, put in 1, otherwise 0. So this is greater. So this be, and then you could just kind of sum this column. So just one idea to quickly figure out how many stocks have a 50-day above. So it'd be 111 stocks, and we could call it 50-day. $200-day. Okay. Why is that important? Because if you remember, if you took my investment class and we did technical analysis, that's a big buy symbol if that's above. Okay. All right, so that should be plenty to get you started on this. Of course, you're going to have to duplicate this work on the other 2 mutual funds. So think about that, and then you are left to make the executive summary. Okay, so I hope you found this video helpful for completing this file, and I will talk to you soon. Thanks.